The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, ladies and gentlemen. Welcome to a Standard Bank webinar hosted by SBFC, Standard Bank Financial Consultancy. Thank you so much for taking the time to join us. My name is Ketiwe. I'm the coordinator of this webinar today. Today, our topic is preserving your wealth and protecting your goals throughout your life journey. We've got two presenters today, two wonderful gentlemen. One is Errol Mayer, which you know very well, and the other esteemed gentleman is Neil Boertes. I'll just tell you a brief bio about them so you know who's talking to you today. Mr. Boertes is a business development consultant in risk for the Liberty Group. He has a B.Ed and a B.Ed honors from the Northwest University. Also has a postgrad diploma in financial planning from the University of the Free State. He has been in the financial industry for the last 9 years, currently a business development consultant, focusing on discovering new business opportunities, forming alliances, and improving performance in the existing business activities, ensuring an efficient execution of strategy. Very well esteemed. And then we've got Mr. Errol Mayer, who you know is a certified financial planner as well, an admitted advocate of the High Court SA. He holds qualifications in finance, law, teaching, and taxation. He has authored a book called Notes on Estates and Financial Plans, which is also now prescribed for many universities. He has previously worked as legal advisor for corporates and as a tax advocate for SARS, and is currently our senior manager in advisory propositions at Standard Bank. So those two gentlemen are going to be hosting the presentation for us and running through the presentation. But before I hand over to them, I just want to run through 2 points. The first one, I want to make sure that everybody can hear me clearly and can see the first screen of the presentation before we carry on. So if you don't mind, if you look on your screen on the right-hand side, there's a panel there, and you'll see a small high five, a small hand with 5 fingers. If you don't mind clicking that to show me that you can hear me, I'll really appreciate that. Before we carry on, thank you so much. I see a few hands coming up. Alistair, Ashley, Basitsana, Carol. Okay, all the hands are going up. Thank you very much. If the volume is low, guys, on your taskbar at the bottom of your screen, you just need to increase your volume. It should help as well. Second point is questions. If there's any questions during the presentation, we will address them, but not during the presentation. So what you need to do on that very same panel where you saw your high five, there's a box with the title questions. You type in your question, we'll be able to see it immediately, but we will address it at the end of the presentation. And then Neil will give us the answer. I'll ask him the question, he'll give us the answer at the end of the presentation. And should you have any other questions that you think of further after the presentation, you can send us an email. There'll be a thank you note with an email address for you to be able to send us your questions. That's it from me right now. I'm going to hand over to the two gentlemen. Mr. Errol Mayer is going to start for us, and then Mr. Neil Boertes will take over from Errol. So I'm going to hand over to Mr. Mayer. Mr. Mayer, thank you very much for taking the time to join us. I'm handing over to you.
Thank you, Ketiwe. Well, good day, everyone. Welcome to another one of our webinars where we once again focus on professional financial planning in a goals-based financial planning environment. Now, goals-based financial planning is nothing else than professional financial planning, an aspect that we at Standard Bank are very serious when placing the interests of our clients first. So when we look at the slide in front of us, you'll see the agenda, which I'm going to talk to, and I'm going to talk around those points. Now, first of all, for some reason, worldwide and in South Africa, goals-based financial planning is often associated with investments, which are designed to meet your goals. However, investments are only one part of financial planning. In this webinar, we will introduce you to some new concepts and explain the importance of holistic financial planning. Now, many of our goals will not realize if we fail to have a proper understanding of protecting these goals in the event of a life risk occurring, such as death, disability, or an illness, and all of these that may deplete your savings. Stated differently, by insuring against life risk, we ensure that we stay on track with our goals. Now, for instance, assume that a person has an investment goal to save for the education of his children, and the financial planner calculates that the future value of 500,000 in 10 years' time will be needed after taking inflation into consideration. The question now arises, what will happen to that goal if that person dies or is not able to work, albeit temporarily or permanently? Or what if he suffers a heart attack and his medical aid is depleted, which means he will have to dip into savings, and these savings were meant for the education goal of his children. So let's make use of a practical example. Assume for the moment that the client dies, and after 2 years he's only saved 50,000 for the education goal. It would make sense to have life insurance of at least 450,000 for that particular goal, and thereby accelerating the goal in the event of his premature death. Such monies can be placed in a testamentary trust, which makes it so important to have a discussion when one will do financial planning around the last will and testament of a client. So a last will and testament is this part and parcel of the discussion in a goals-based financial planning scenario. In the context of goals-based financial planning, a last will and testament is nothing else than a financial plan protector. It is for this reason that I refer to risk policies as goal protectors, or perhaps stated differently, goal accelerators. No proper financial planning can be done without fully understanding what holistic financial planning is all about. We can thus say that financial planning is the process to develop strategies to assist clients in managing their financial affairs to meet life and financial goals. Let us look at the worldwide accepted meaning of what financial planning is all about. And thereafter, we will explore some life risk principles and do practical examples. So let's move to the next slide and see there what we have in front of us is the definition of financial planning. Now, if we would read the definition, first of all, this is accepted worldwide and in South Africa in the Code of Ethics, what financial planning is all about. And there it says, financial planning is a process to develop strategies. And these strategies all relate to managing the financial affairs to meet life and financial goals. And that process would include reviewing all the relevant aspects. And that, what comes to mind is the marital regime, if you're married in community or out of community. All of those aspects must be taken into consideration to understand the client's current situation and comparing them to the client's desired situation. And then most of all is to have these needs and wants, your goals, to quantify them and make them real. And this is where the financial planner comes in. So let's have a look at the next slide, which goes to the heart of what we do at financial planning. So this slide on the left-hand side, you will see there is creating value, giving purpose, investments, and then passions and legacy. And number 5, you'll see life and disability. Now, looking at this picture, we can picture life as a balancing act. From a financial perspective, we have to balance our assets and liabilities. We can also refer to it as creating value and giving purpose, as per the slide, which often relates to a person's why in life. Why am I doing this? In this aspect, we are all unique, and every client should be treated differently. A value that we at Standard Bank recognizes as a fundamental principle in our value belief system, that our clients comes first. The 2 quadrants on the left-hand side is referred to the assets, and the 2 quadrants on the right-hand side is referred to liabilities. And this is what we must balance. The assets, the potential to earn income, must be balanced with our liabilities, which is future liabilities like retirement and education. So we are all different and we have different needs. The salaried person will have a pension fund and group life cover and possible some other risk benefits. And I'm looking at the first quadrant, the creating goal. It's not always the same for entrepreneurs. Entrepreneurs, by their very nature, would invest in their business, and we often find that they may have started up the business with the retirement monies that they have withdrawn from their retirement funds. So therefore having a very low save and invest. And so you'll find that the employed person may have more funds in the save and invest quadrant than the young entrepreneur. And that shows the uniqueness. Yet, we all have to balance our assets and liabilities. Now, whatever the case may be, or stated differently, the unique risk profile of that particular client, the fact remains that the asset side must balance with the liability side, which are the two quadrants on the right-hand side of the picture. Now, liability sides of the quadrant is to give purpose to the wealth we have created. That is to provide our children with education, maintenance needs for a surviving spouse, and etc. But note in particular point 5, which encircles the framework, and this is where the protection comes in. And that is the focus of our webinar today. Now, let us move on and analyze some of these risks that we may encounter in life. So, when we look at the next slide, and let's talk about life cover. This is life insurance. Now, think back of my previous example where a client wanted to save for an educational goal. In the example, we assumed that he died and after 2 years only saved 50,000 for the education goal. It would have made sense to have life insurance of at least 450,000, thereby protecting or accelerating the goal in the event of premature death. Such monies could then be placed in a testamentary trust, which makes it so important to have that discussion around the last will and testaments, which I've said before. And the last will and testament, therefore, as I said before, is the financial plan protector, protecting all these goals. So let us analyze now some of these fundamentals about life cover. Now, first point is, I find that life cover is nothing else than a grudge payment for many people, because you don't get something back. Life cover is not meant to be an inheritance without a specific purpose. Because then we're in the area of gambling or wagering contracts, something that may have the effect that an insurance contract is not enforceable in law. No. The purpose of the life cover is to rather replace an income stream or repay a capital debt, thus speaking to the creating value on when we look at the wealth quadrant and the first one. Creating that value, we must replace it with something else. So it would be silly to leave an income stream to a spouse to pay her debts. No, it would be a lot cheaper to effect life insurance to repay the capital debt and estate liabilities such as death and executive fees. Now, I have alluded to the fact that an insurance claim may not be honored if the purpose is to use as a wagering contract. And the term we use in the industry is whether there's an insurable interest in insuring a person's life. This is especially so in the business world. Companies want to protect the most valuable asset of their business, such as a key person. In a family, the spouses are effectively key persons in a household. Back to the company example, the quantum of the insurance must relate to the loss of the company that it will incur if such a key person dies. Now, if the company overinsures, then we effectively profiting from such person's death. Hence the requirement in insurance law that there must be an insurable interest. Now, a beneficiary nomination is a very handy contractual arrangement to have funds immediately available for a spouse and not frozen in a deceased estate. People often say to nominate a spouse as a beneficiary is to save on executive fees, but this is a short-sighted reason and approach. The immediate cash flow advantage by paying the right person is advantageous if done in terms of a well-considered financial plan, especially if all the estate liabilities are accounted for. So financial planning is rather concerned with the cash flows upon death and must be combined with a well-devised financial plan. Such a plan must ensure all estate liabilities are accounted for. To nominate a spouse as a beneficiary of a policy is for her to have immediate funds available, knowing that there's no need to pay monies into the estate for estate expenses. So let's have a look at the next slide and talk about another risk event, and that is disability. To make things easy, we can distinguish between the two kinds, the income disability benefit and the lump sum. Now let's talk about the first one, the income cover. The purpose is to compensate for the loss of earnings experienced as a result of disablement. Now, a monthly income amount is paid where the impairment is assessed according to a scale of activities of daily living, or monthly income to cover business expense, or temporary disability income that pays out for a limited period, usually 6, 12, or 24 months. The monthly income is restricted to the percentage of a normal monthly income as defined in the policy, usually 75%. And this rationale relates to the principles that I discussed earlier of insurable interest. You don't want people to go and hurt themselves in order to secure an income. And therefore, we adhere to the principle of insurable interest. In the past, some of the policy contributions were tax deductible because it's replacing income. But since the recent tax changes, the premiums are not tax deductible, but the income process would be tax-free. So when you do the calculation, you can ignore the tax that you have to pay because that amount is tax-free. Now, what about the lump sum disability? So when will one then opt for a lump sum disability benefit as opposed to an income disability? Well, instances where a person becomes permanently disabled and therefore unable to work or earn an income comes to mind. One is effectively replacing your income earning structure, the capital replacement. The benefit is meant for capital expenditure, such as to purchase disabled bodied equipment, such as a modified car, modified lift in a house. However, it can also serve the function to compensate for future loss of income, as well as costs associated with being disabled, as alluded to above. So let's move on to the next slide and talk about another important life event, which is dread disease. And where does that fit in? Remember, my principle is never to profit from this, but is to ensure that we can stay on course in reaching our goals. So, examples of a dread disease would be heart attack, cancer, stroke, coma, etc. And what's very important, that it's intended to provide for immediate expenses for best possible medical care. So there's a very close causal link between the medical aid provisions one has made and this benefit that pays out. And that can often fill the gap or just make things easier. So the additional payment is meant for a major impact on the quality of life and future life expectancy of policyholder, and this is where this benefit fits in. So let's move on to the next slide and talk about, and I've selected only two terms, and that is the accelerated benefits and standalone, because it is quite important to make sure that these benefits fits the risk profile of that client. Because one must get the maximum protection to protect your goals with the minimum expense. And as I've said before, one cannot over-insure because this is not about inheritance or an enrichment. Now, let me explain accelerated benefits. In the earliest days, life insurance companies only covered one event, namely death. As the industry developed, it became accustomed to and add other benefits, such as those benefits discussed earlier, namely dread disease and disability benefits. If, for instance, one ensured that the bond on your house is settled upon your death, one will include such amount in your total life cover. But what if you become disabled prior to death? It would then make sense for the bond to be settled prior to death. Also, the capital amount is no longer needed at death. We therefore accelerated the capital payment to pay the debtor's disability. The death cover will thus be reduced proportionately. For example, if you are insured for a benefit of 2 million and your outstanding bond is 800,000, a lump sum disability benefit of 800,000 will accelerate the death benefit so that only 1.2 million is available in the event of death. However, consumers demanded that some of these rider benefits should be available as new standing and not linked to the death cover of a policy. Using the previous example, if the disability benefit had been a standalone cover, you can claim for 800,000 and retain the 2 million life cover. This means that the total benefit is costing 2.8 million, which by all standards should be more expensive. And this speaks to the risk profile of a client. And this is how death and disability benefits should be viewed by a financial planner. It is therefore very clear that an astute financial planner will have a good understanding of the risks and goals you wish to protect, quantifying these amounts and ensure that it is the most cost-effective way of doing so. So let's move on to the final slide, the next one, and just position ourselves the role of the financial planner. So go back to the definition of financial planning and you will see that explains exactly what it is supposed to do. So we at Standard Bank, we have contractual relationships with product providers and engage with them in a contractual manner to underwrite these risks we were discussing in this webinar. We at Standard Bank go through a rigorous due diligence process to vet all the product solutions and ensure that the interest of the client is placed up front. Our financial advisors will be able to assist our clients to conduct a proper financial needs analysis, be able to formulate strategies to attain these goals, notwithstanding the curveballs life throws at us, such as sickness, accidents, death, etc. I have asked Neil Boertes from Liberty Life to join us and to tell us more about these products that I've been discussing. Thank you very much from my side, and Neil, it's over to you now.
Thanks, Errol. Good afternoon, guys. So, if I was to ask you to raise your hand when I ask 3 questions, you would understand why it is so important to talk to your planner about risk cover when you discuss financial planning. So, normally when I do a face-to-face presentation, I ask the audience, who of you knows somebody that passed away in the last 12 months? The second question, who of you have or know someone that have been diagnosed with cancer or any other dread disease in the last 12 months? And then the last question, who of you have or know someone that was retrenched in the last 12 months? So normally when I ask these questions, there is not a single person who haven't raised their hand. And that is why we do the exercises, not to scare the audience, but to help them realize and understand that we can't escape these realities. We all insure our cars, our houses, cell phones, jewelry, but we rarely do we see the need to insure our income and our family's financial futures. I've seen in my own family the difference between having cover and not having cover in place when a family member was diagnosed with a critical illness. And that is why I made it my mission to help as many people as possible. So if we can go back to this slide, we have categorized or placed clients into various stages or segments. So as you go through the various stages of your life, your priorities and ambitions are likely to change. At Liberty, we know how to help you gain a better understanding of the leading risks and most appropriate cover for people in your particular life stage. I also want to explain the different segments to you, but before I get into the needs and specific cover for the segments, let's just quickly run through them one by one. So you'll see the very first block is the young achievers. Then we have the young parents, established providers, and the empty nesters. So with the young achievers, as you progress from your early 20s to 30s, you are establishing your career, settling study loans, building personal wealth, and accumulating assets. All of this is possible because you have the ability to earn an income. These youngsters tend to have a lot of unnecessary debt as they are just starting out, like I just mentioned. They have car finance, credit cards, and retail accounts, just to mention a few, or maybe the most popular. It is important that they are in a position to meet these financial obligations should they become disabled or retrenched. In most instances, we would see parents sign surety for these debts, and I'm sure we don't want the parents then to be liable should something happen to the youngsters if they weren't insured. The second block there is normally when you start with a family as a young parent, it is likely that your priorities will change. During this phase of your life, you are more focused on providing a safe home and financial security in the form of savings and insurance for your loved ones. These clients also have more responsibilities now because they have young ones that are completely dependent on them. In this segment, we see parents make lifestyle adjustments in the form of bigger houses and bigger family cars. That puts more financial pressure on them. Should something happen to either one of the parents, will the surviving spouse still be able to maintain the lifestyle they worked so hard to achieve? Will they be able to afford to keep the children in their school of choice? And will they be able to afford aftercare? Or maybe even a helper at home to help with the tasks that await them after work? Then we move on to the established providers. So in this segment, your loved ones are still a priority, but retirement is also a growing reality, as Errol mentioned earlier. As you get older, the probability of contracting a serious or life-altering illness increases. It is also in this stage of the client's lives where they contribute most to their retirement funding. You will see at the established provider that the graph there peaks at the established provider just before they go into retirement. So, will you still be able to afford to retire, or are you going to dip into your savings to sustain you and your family should something happen in the form of a critical illness or disability? We know that roughly only 3% of our population have made sufficient provision for retirement. So why even take the chance with your savings having to dip into that if you already don't have enough? Then the last segment is the empty nesters. So as an empty nester, you've worked so hard to accumulate assets over your working career and are now looking forward to retirement. Maybe you had your eye on that little house in Hermanus where you and your loved one are going to retire and spend the rest of your days. However, your monthly retirement income may not be sufficient to cover the cost of long-term care following a severe illness or impairment. Should something happen to you or your spouse, which is more likely in this segment unfortunately, you will still be able to live in retirement. Will you be able to afford frail care or make needed changes to your house or a car if you become impaired? Or will you have to move back with your children and become a financial burden on them? So, going directly into the young achievers again, 52% of our claims linked to the young achievers were due to these top causes. So every year we see younger and younger clients being diagnosed with cancer, and it is really a big concern and can be contributed to a lot of factors. We see that ladies get diagnosed mainly with breast cancer and men get diagnosed with prostate cancer. According to Dr. Pale, the younger a person is when they are diagnosed with cancer, the bigger are the chances of them being diagnosed later again. That is why it's imperative that young clients are covered as soon as possible to ensure that they are still insurable. Another big concern is the amount of retrenchment claims from this segment. The biggest part of our country's unemployed population is made up by this segment, but the good news is that we can help with a temporary solution while they find a new job. So understanding the claims or understanding the young achievers, if you look at the very first bar there, that's labeled cancer. So with the help of medical advancements, people survive cancer and live longer. Please note that only 30% of the claims relating to cancer in this segment was death claims, and 50% of the claims was for critical illness. The second big area of concern is the amount of retrenchment claims, as I mentioned earlier, which made up 11.7% of the claims in this segment. 9.7% of the claims in this segment was triggered by motor vehicle accidents, and you can see here that close to 80% of those claims were death claims. Unfortunately, I can confirm that the majority of those claims were due to young males drinking and driving. So young achievers need to ask themselves the following questions. Do I have enough savings or insurance in case I face retrenchment? Will I be able to support myself for the rest of my life if I become disabled? Do I have debt, for example, outstanding student loans or motor vehicle loans? Will I be able to achieve my saving goals if I can no longer work? So let's look at the young parents. In this slide, we see that cancer claims increased from 15% in the previous segment to 24%, with an increase in cardiovascular and central nervous system claims. You can see that the majority of the cancer claims was for women, while most of the cardiovascular conditions was for our male clients. Clients in this segment need to think about how a trauma-related event will affect their families, their children, their spouse, and their lifestyles and their futures. We still see that clients survive dread diseases that they are diagnosed with. Dr. Marius Barnard very wisely said that we don't need cover because we are going to die. We need cover because we're going to live. And in this slide, just like the previous segment, we can see that only 30% of the cancer claims was for death cover, and only 40% of the cardiovascular condition claims was for death cover. So the rest of those clients survived their dread diseases. So the questions the clients need to ask themselves in this segment is, if my spouse or I die, will I be able to pay for daycare and housekeeping? Do I have outstanding debt like a mortgage bond or motor vehicle loan? Will my children be able to complete school and university or college if I die? Can my family care for me and maintain their living standard if I become disabled? Moving on to the established providers, the two main causes for claims are still cancer and cardiovascular conditions. You will see that this won't change throughout all of the slides. With the main cause for women are still cancer and the main cause for claims for men is still cardiovascular conditions. The main causes for cancer claims are still breast cancer for women and prostate cancer for men. Please note the amount of death claims for clients in this segment and that the main causes. So if we look at the cancer claims, the death is still only 30% of the claims were paid out for cancer was death claims, with still only 40% of the death claims in this segment was cardiovascular conditions. Because of the age of this segment, we see more central nervous system claims and we also saw more musculoskeletal claims. And very interesting, we see a comeback made by motor vehicle accidents in this age group or segment. And just like with the young achievers, this unfortunately is also mainly caused, or the cause for claims was for male clients. So understanding the empty nesters, this is the first time where we'll see that the cardiovascular conditions claims are more than the cancer claims. So again, cardiovascular conditions or the claims there was more for the male clients than the female clients. And then we saw the cancer claims then be more for the ladies or the female clients than the men. And when we look at the cancer claims, it is still breast cancer claims for the females, for the women, and then prostate cancer claims for the men. In this segment, we do see then that majority of the claims was death cover claims. But what I want you to note is that we still have a large percentage of the claims where it was loss of income protection or disability claims and lifestyle protection claims, which would be then the critical illness or dread disease claims. So we still do see that clients do survive these conditions or events that happen to them. And that is also where we can help them, because with our whole of life cover, we can make sure that even after retirement, in your old age, we can still help you meet your financial needs. So the questions then that we need to ask here is, if something happens to me, will my spouse still be able to live in retirement? If something happens to me or my spouse, will we be able to afford the needed changes that we need to make to our houses? And these are the things that we need to keep in mind here. So in the time that I've done this presentation, we were able to pay out 8 claims and help change 8 lives for the clients. Thank you very much for your time.
Thank you so much, Neil. Very insightful. That's an eye-opener. A lot of people don't think about what if I survive and I live with cancer, then I'll need that cover. Always think about death. So let's just see if there's any questions that popped up from the section. The first question that I do have, though, is I am a 29-year-old. How much cover would I need And how much would it cost? I assume that's maybe just the life cover. I don't know if you're going to add the ancillary benefits like the dread or the disability. Neil?
So when we look at what cover we need and how much it's going to cost, we need to look at a full financial need analysis that needs to be done by the financial planners. So the cost will be based on your personal information, your avocation, occupation, your weight, your height, how much you smoke or drink. But as we saw in the claims now, that even our younger clients don't escape these events. So the best advice is for them to get the cover as soon as possible from an earliest age as possible, while it's still more affordable, and the likelihood of exclusions or loadings where we either exclude certain benefits or load certain benefits are much less likely, and then the cover can be carried throughout their whole lives.
Got it. Second question is, I have life cover, but I've never thought of retrenchment cover. How do I get it? And how do I get any form of this retrenchment cover?
So it is a lot easier to get retrenchment cover than you would think, basically because there's no medical underwriting. So when you apply for the retrenchment protector or retrenchment cover, we would just ask for you to have either life cover in place or any other non-accelerated disability or income disability benefits. And the only thing that we will need is the proof of your income.
Okay, simple enough. We've got another question from Sanjeev. He's asking, are there any products for someone approaching 60? Are these products much more expensive?
We do have products available for the clients in that segment. That would typically be either the established providers or the early empty nesters. But unfortunately, those products will be slightly more expensive, and I'd like to use slightly more expensive because it's always also based on the client's specific profile. Their health conditions, have they ever claimed in the past? But yes, we do have products available for that.
Okay, so Sajiv, I assume maybe get a hold of a planner. We can look at those products. And then we've got Dumisani with a very interesting question, Dumisani Bogan, who says, would you recommend a child paying cover for their parent? And is this allowed?
So Errol spoke about that quite elaboratively. So it's all about insurable interest. If I can use an example, say my mother is retired and I bought a house for her to live in, and maybe she pays rent for that house directly to me. So should something happen to her, I would be in a worse off financial position. So in that instance, I'm sure there would be insurable interest, and then I can take out the life cover on my mother. I pay it, and I can be the beneficiary because I am providing for her at the current stage. So that shouldn't be a problem.
And there's insurable interest.
There's insurable. So the big thing is there must be insurable interest.
Yeah, it's not a get rich quick scheme.
No.
All right. And then last question, still from Sanjeev. He says, I own my own business. In an own business scenario, how does cover work? So I guess it's for business cover instead of individual.
So we have different categories that we also rate the clients under. So a business owner would also then qualify for additional benefits, if I can put it in that way. So a business owner would qualify for 7 days backdated waiting periods, which is a lot better because you can have, if your claim has been submitted and it was approved and paid out, we can start paying from day one. So the fact that you are a business owner per se might not play that big a role. We can look at the type of industry that you are, but there are more benefits than in terms of waiting periods that we can look at for business owners.
Okay. We've just got some other questions that have popped up from Hupozo. She says, what are the disadvantages of replacing a life cover with a vast business investments or investment?
See, the life cover versus a business investment, it also depends on your own situation. So you need to see a planner. They need to do a full financial needs analysis, and that will determine, they could draw up a list with all the pros and cons and see where you would be best suited to either have investment or have life cover in place.
Correct, because it's all up to the individual. So you'd have to sit with someone individually. And then Ruan Janse van Rensburg says, income protection for a sole proprietor. What do you say about that?
We can do it. So the income protection, we just need to look at specific. There might be some underwriting requirements. We need to look at the industry that is in. But yes, we can look at retrenchment protective for income protection. Income protection for a sole proprietor. So it, like Errol also said, it's there to replace lost income. So if you have your own business and you lost a portion of your income or all of your income, then there would be or could be a successful claim. But I would also advise you to look at business overhead expense protector, where you can then also insure your business's income, ensuring that your business can continue when you are off sick or maybe suffer disability or need to recover from a rare disease, and your employees in this way is also looked after then.
Perfect. Very good questions, very good answers. Thank you very much, Neil. I hope that answered all your questions, ladies and gentlemen. And as Neil referred to, some of you might have to sit with a financial planner, look at your individual situation to come up with an appropriate solution. So if you are looking for a financial planner, I recommend that you walk into any Standard Bank branch in your area. There is a financial advisor sitting in that branch. Or if that's not an option for you, tomorrow there is a thank you note that comes out. It will have an SMS line that you can SMS to, and then someone will call you to make an appointment with you with a financial advisor. The session is recorded, guys, because I know some people miss some sections because they tune in a bit later, or the sound becomes a problem where they're sitting. So it is recorded, and on that same thank you note tomorrow, there'll be a YouTube link which you can click on and see all the webinars that we've done for you guys, as well as today's webinar. Okay, if you are a planner or you one of our internal staff, it is on the SBFC portal. Hope that makes sense. Thank you very much for this session. Thank you very much for sitting in. You will have another session that's coming up next month, so look out for that invitation. Mr. Errol Mayer, Mr. Neil Boertes, thank you very much. It has been very insightful, and I hope you guys have a good day further. Goodbye.